Good evening.
Good evening, Prof.
Can you hear me? Can you hear me?
I can hear you.
Okay, thank you, ma'am. Yeah, yes. Continuation of our group accounts. Good evening, everybody. Good evening. Let me share the screen. Okay. Good evening, everybody. This is FCA online platform. Welcome. You have started this group accounts. You all know till we end this class is going to be group accounts. One way or the other, one types or the other is going to be group accounts. Okay. Having said that, we are in a simple group. By God's grace, tomorrow we should be able to move to associate. And I've been racking my brain to make it more lively and I believe by God's grace, God will see you through so that you can understand that group is very simple with the approach. Okay, let's recap so that people can join the class. I just only have 9 participants. I was told that some people are joining late and it affects our class. No problem. We'll start this class by defining what is group accounts. Even then, we say group account is account of the parent and that of the subsidiary, prepared and presented as if they are a single entity. They are not single entity anyway, but we just prepare them as if they are one. That is why the problem of the adjustment, they are single entity. That means it brings about, you cannot make profit for yourself. Selling to each other and make profit is not welcome because you are one. You can't sell to yourself initially. You can only sell to third party within the group. Intergroup sales must be eliminated. So it's the definition that brings about so many adjustments we need to do in group accounts. But irrespective of that, we must still believe that the account is prepared and they are one. Why? Because the substance of the transaction, substance over form, the substance is showing one single economic reality, while the legal form is showing two companies. Well, having said that, we move to various costs of investment. We talk about cash payments. We talk about deferred consideration, share consideration, share estate for the loan of subsidiary, and we talk about the contingent consideration. So the 5 costs of investment is a question they can decide to ask you 3 or 2, but always remember after you have treated your cost of investment, remember that you ask the question has it been recorded? That question needs to be asked if it has been recorded or not. If it has been recorded or not. If it is recorded, what is your own duty? Just remove from investment. Credit investment is a statement of financial position and debit cost of investment if it has been recorded. That is your own duty. That is your own. But if it has not been recorded, you don't need to go and record it again in the investment statement of financial position because you are still taking it to goodwill. It will amount to wasting of time. What you need to do is just that. Debit the cost of investment and every other part that needs to be credited or debit, you go about it. This is what we are saying when it is recorded, no record. But you must ensure, you must be very sure that the question will put it to you, it has been recorded, not recorded. Now, if the question is silent, go to the investment he reported. That means it must have recorded it. If it has not recorded, the question will tell you the cost of investment has not yet been what? Recorded. Always remember all this. It is very important. Okay? Having said that, we move to how to calculate goodwill. We said that goodwill can be calculated by using cost of investment. We have learned. Add NCI. The NCI can be valued in two ways. It's either share proportionate or fair value. If it is share proportionate, okay, no problem. How do we know it is share proportionate? We say when the question is silent, it does not tell you what to do. It does not give you any clue on fair value when the question is silent. 2, company policy. Company policy. That is share proportionate. And he said any goodwill gotten using share proportionate, the goodwill belongs to parents only. And if there is impairment in the question, only the parent will suffer the impairment because it's the owner of the goodwill. Then we now said, what happened? Oh, my guy is on the line. Thank you, Mr. Prof. Taiwo. I salute you, sir. Okay. Thank you for joining this class. Having said that, that's okay. If it is fair value, how do we know it is fair value? Market price per shares of subsidiary or NCI will be given. Market price per share of subsidiary or NCI will surely be given. That is 1. 2, we said fair value of the whole subsidiary will be given in any question. Fair value of whole subsidiary. And we said, 3rd, if they give me fair value of the whole subsidiary, I will multiply NCI percentage on the whole of the fair value of the whole subsidiary of the company. I will just multiply that NCI percentage on the fair value of the whole subsidiary. That is that. Then, how do I know it is fair value? Goodwill attributed to NCI will be given. I say if they give you goodwill attributed to NCI, they've given you to play penalty without goalkeeper in the post. What do you need to do? It's either you get that of the parent, which is using share proportionate, add it to the goodwill attributed to NCI, it will give you total goodwill. Or you go by the formula, cost of investment, having got your cost of say, goodwill attributed to NCI, then the rest. Get an NCI percentage of the net asset, you add everything to give you the purchase consideration, you less, it will still give you the same thing. Any way you approach it, it's good for you, no problem. Any way you approach it, it's good for you. Okay? Then they say sometimes the fair value of the NCI will be given directly in the question. The fair value of the NCI will be given directly in the question. If that be the case, you just click it. We said any goodwill getting using fair value belongs to both the parents and the NCI. Belongs to both the parents and the NCI. Then we can split them if we wish. The one that belongs to the parents, the one that belongs to NCI. I have told you that always remember, even in fair value, the goodwill attributed to NCI, even in fair value, the goodwill attributed to the parent is share proportionate. Even in fair value, the goodwill of the parent is share proportionate. You can also get out of the NCI by saying NCI value at fair value at date of acquisition, the fair value, NCI percentage of the net asset at date of acquisition. The difference between the two will give you what? Goodwill attributed to NCI. We said any goodwill gotten using fair value belongs to both the parent and NCI. Therefore, if there is impairment, both of them must suffer the impairment based on the group structure. By debiting, after you have credited the goodwill, the debit will retain any of the parents, and NCI value will also be debited to reduce the value of the NCI. This is what we have said. And we go to retain any. I said some question will not give you retain any at the date of acquisition if it is during the year acquisition, like this Bola question you're about to solve. no retain any at date of acquisition because the date of acquisition to date of consolidation is lesser than 1 year. Is lesser than 1 year. No volume. Os. Prof. Adesua.
Prof. Mulet, I'm with you, sir.
Can you hear me very well?
Yes, I can hear you clearly.
Somebody is saying low volume. Okay, I should increase my.
Probably the person needs to check the connection or use an earpiece.
Okay, not from my own end here, ma'am.
No, sir.
Okay, thank you. Okay, where we were saying, okay, retain any at date of acquisition will not be given a uncertain question. When it is during the acquisition, what do we mean by during the acquisition? That means from the date of acquisition to date of consolidation is less than 1 year. If that happens, that is during the acquisition, no retain any. Even though you read the question like 5 times, you cannot give you retain any at the date of acquisition. Because the account is less than, you have to calculate the retain, which we are going to do today. But this one, when profit is made, when loss is also made. When profit is made, when loss is also made. It's possible company can make profit, they can also make loss. Can also make loss. So in case there is a loss, what do? We have 2 questions to solve this night. Let's go straight to question that we have at hand, which is question 1, Bola Limited. Question 1, Bola Limited. On 1st of April 2016, Bola acquired 75% of equity share capital of Ambode. Oh, they've given me the good structure directly. I told you from the start of this account, good structure be determined. I say 1, given directly from the question, which the question has given us. 2, I say, through the numbers of shares acquired by the parent. I say 3rd one, through the dividend analysis. They've given us directly 75%. What comes to me in exam, to my brain in exam, must be okay. How many percentage does it make that 75? What do I need to do? Total numbers of shares in subsidiary equals to the values of shares, the one he has, the book value, divided by the nominal value. To get the total numbers of shares, multiply by the 75%, you will see it also in the solution. In allowing for Ambode difficulties, Bola made immediate cash payment of only 150 kobo per share. He paid per share, although he acquired 75% shares. He now paid per share. I will convert it to bond payments. I make a percentage that make up the 75. After having got that, I will now multiply by the 150 kobo he paid. In addition, Bola will pay a further amount in cash on 30 September 2016, please. Avoid error, 2016, please. If Ambode returns to property by that date. But the value of this contingent Prof. Adesua.
Yes, Prof. I can hear you.
Okay. The contingent, okay, said the value of this contingent consideration and date of acquisition was estimated to be 1.8, but as of September 2016, in light of the continuous losses, the value of this estimate is only 1.5. It does not meet target, below target. As at the reporting date, when I was reporting, it is 1.5 I will pay instead of paying 1.8. This is a contingent consideration. How do you know to know? They say if Ambode returns, so he has given the condition, and the fair value of this arrangement, the value of the contingent consideration at date of acquisition was what? Estimated to be 1.8. But as September 2016, in light of the continual losses, the value was estimated to be only 1.5. The contingent consideration has not. Okay, the contingent has not been recorded. He has to. It means the cash, said the contingent consideration has not yet been recorded by Bola. Overall, the director of Bola expected the acquisition to be a bargain purchase. Let's work it if it is bargain purchase. At the date of acquisition, shares in Ambody had a listed market price of $1.20 each. Below are the summarized financial statement of both companies. This information, let us do it together. That just everything here before we go to additional information. Now, what do we need? I will go to the statement of financial position, the shares. Let me go and see the shares. Oh, what is the values of shares? 6,000. What is the nominal value? 50 kobo. Can you see that? The nominal value is 50 kobo, where the value of the share is 6,000. I need to divide to know the total number of shares. Let me share the solution to that so that we can do. Okay. Now, you all know the group structure. Okay, this is the solution to the question mark. Those information we need. The first information, number of shares that make up the 75%. We know that parents acquire 75%. What is the total numbers of shares? The total number of shares, the value of shares divided by the nominal value. 6,000 divided by 0.5, will give us 12,000. Okay, this is the total numbers of shares that exist in the company. Now, the parent shares acquire. The parent shares acquire 75%. 100% of the total numbers of shares will give me 9,000. And if you want to convert that, 9,000 divided by 12,000 will also give you what? Times 100 will also give you 75%. That is that. And he paid how much? 1.50 kobo per shares. Cost of investment, he used to cash payment and contingent consideration. He acquired 9,000 shares, 1.50 kobo, equals to what? 13,500. Equals to 13,500. I told you, anytime they give you the question in your hand, first of all, open everything. Please, open everything, all your accounts, open it down. You say, okay, first, you ask me for pay on head. I will open page 1, pay on head. Revenue, I will just list it down the way I've shown you yesterday. I will go to page 2, statement of financial position. Open it. I open group structure accounts. I open adjusted retail earning. I will leave like for group structure, not more than 30%, and not more than 3 pages for simple group. For adjusted retail earning, I open it down. I will say determination of net assets. I open that down. Goodwill, I open it down. Retail earning of the parents, valuation, general value of NCI, I open everything down. For the goodwill, write the formula out. That one will serve as a mark already. As you are not reading, you will be posting to make the job faster. This is what we do in physical class. As we are reading, we are posting immediately. Say, cash payment, cost of investment, make 2 cost of investment, cash payment, contingent consideration. Cash payment 9,000 times 1.5 give me 13,500. Accounting entry to raise, cost of investment must be debited to calculate goodwill. If it has not been recorded, I will credit cash to remove the money from the cash, and cash will be depleted. But if it has been recorded, investment in the non-current asset statement of financial position, I will credit it, 13,500. Cost of investment, I will not debit it. But the question tells us that it has not been recorded. It has been recorded. He said cash has been recorded, but contingent has not been recorded. Now, what is my own duty? Let us go to the statement of financial position. Now, there is no investment. Definitely must have put it in part of his financial assets. Minus 13,500. I will now take it to the cost of investment to calculate goodwill, 13,500. That is why you see here, minus 13,500. Then the goodwill must have been debited, 13,500. Cost of investment, 13,500 to calculate goodwill. Now, let's go for that. To the cost of investment we are doing. Okay. For the contingent, below target, said, oh, if it returns to profitability, it will pay in 1/8. It has happened at date of acquisition. Cost of investment must be debited. Retain any of the parents at reporting date. Instead of paying 1/8, he said he can only pay 1/5 because the company was continuously making losses. Okay, I'll pay 1/5. Instead of paying 1/8, 1/5, the 300 credit retain of the parent is like a gain to him. And current liability, 1/5, only has 1/5 as a liability to pay the next 6 months. And I was told that this has not been what? Recorded. I will not record it. Oh, cost of investment to calculate goodwill, 1/8 will be part of it. We look at it, 1/8 contingent, 1/8 plus cash payment. These two will go to total cost of investment, cost to be debited for calculation of goodwill. The retain any of the parents credited. Let's all see. If you look at the retain any of the parents here, retain any of the parents, contingent consideration, gain to him, 300, credited to his account. Then the liability, he has 1/5. Go to the current liability plus 1/5, credited. Immediately I'm doing something, I'm posting immediately. Immediately I'm doing it, I'm posting immediately. After I've opened everything, as I'm reading the information, getting what I'll post. This is the best approach. First of all, open everything. As you are reading, you'll be posting. There can't necessary to balance this. You have opened it down already. You will be posting. Okay. Having said that, my total cost of investment, one has been recorded, one has not been recorded. I posted it. My total cost of investment will now be what? 15,300, which should be go to my goodwill calculation of my goodwill calculation. Goodwill 15,300. Goodwill 15,300. The question I give us, oh, if you look at the question, it gives us NCI at the date of acquisition, showing it is fair value. But I will confirm the question from the question. Let me share the question again so that you can see. I will confirm from the question whether it is fair value. Let's go down. You will see they indicate to me. Bola policy to value non-controlling interest. Yeah, they say it's the Bola policy to value non-controlling interest at fair value at date of acquisition. For this purpose, Ambode share price at that date can be deemed Ambode share price at that day, the day you acquire, can be deemed to be representative of the fair value of the shares held by the non-controlling interest. Uton has told me. Now look at the share held by non-controlling interest. Oh, at date of acquisition, shares in Ambode had a listed market price of 1.2 each. So this is this. They've given me the market price per share. So let us go to solution now so that you can see. Now let's NCI 36. How do we get the value of the NCI? Let's see. Valuation of NCI. The group structure is parent 70%, NCI is 25%. Total numbers of shares in existence is 12,000 after converting numbers of shares. How many percent does NCI have? 0.2. 0.2 times 12,000, that's 1.2, give me 36. Alternatively, the numbers of shares, market price per share, multiply it, we will still give you the same thing. It will still give you, if you multiply this times this, then times 0.25, it will still give you the same thing, 36, because it's fair value. That is why we get the value of the NCI to be 36. If we go up, let us go up. We add the value of the NCI to our cost of investment for the goodwill calculation. For the goodwill calculation, add NCI at fair value, 36. If you add the two together, it gives me 18,900. That is the information. The first information in Bola question before going to additional information. That is the first one they gave us. I'll give us 3 minutes to react to those information. The first one, the one we have done. If there's anyone that asks question, let us have a chat so that we can clear the air on that. Based on the first information, which information am I talking about? Let me share it. This information, this part of information, from here downward, we have done this. From here to this, we have done all this. Every information that needs to be carried out here, we have done. We want to go to additional information. But I'll give you 3 minutes to react to anything that is not clear here. So let us iron it out. And if it is clear, let's move to additional information. $7.29. You have 1 minute more. One minute more. Okay. Somebody has a question? Okay, they've given, he said, I should explain how the contingent consideration was calculated. Look at what we are saying under the contingent consideration. Said, okay, Bola will pay for the amount in cash on 30 September 2016, not 2017, if Ambode returns to profitability by that date. If he returns to profitability, condition, contingent consideration. The value of this contingent consideration at date of acquisition was estimated. They both agree. If you return to profitability, I'll pay you 1.8 million. No story. But as of September 2016, when we are reporting, in light of the continued losses, does not meet the target. The value was estimated to be 1.5. They now told us the contingent consideration has not been recorded by Bola. He has not recorded it. What do I need to do? First, do not meet target. Cost of investment, because it has happened at date of acquisition. Cost of investment, you promised 1.8 million. I will say cost of investment, debit 1.8 million. Next, I will now say, okay, no problem. Instead of paying 1.8 million, I end up paying 1.5. The retain any of the parents, 300,000 will be credited. then current liability will now be what credited 1.5. Okay, when a transaction has been recorded or not, I will still explain this at the end of the class. When transaction has been recorded or not, I show you. You will need to. This is one of the traps in exam. You are supposed to be familiar with that in your FR days. The question will put it to you. Look at it. They say the contingent consideration has not been recorded by Bola. You must always ask the question. You have to ask the question, not the question asking you. You have to ask the question, Anytime you see cost of investment, has it been recorded? Has it not been recorded? You must ask the question. Out of the 5 costs of investment, some are used 3. When we go to per question, he used like 3. 2 has been recorded. Or he used 2. None of them has been recorded. Then the question will tell you, you are now a professional. You have to ask the question, have it been recorded? At the end of this class, I will throw more light. After the end of the solution, I will throw more light on recorded or not recorded so that you can understand. Now, because of time, let's move to the additional information, and we take the additional information one after the other as we are posting. Following information is relevant. Information 1, additional information 1 is relevant. At date of acquisition, the fair values of Ambode's assets were equal to the carry amount. Oh, no changes in the net assets. With the exception of an exception of leased property. These are the revaluation. These are the fair value of 2 million above the carrying amount and the remaining time of 10 years at date of acquisition. All depreciation is included in the cost of sales. Let us see that one. I told you about fair value adjustment, additional information 1. I have interpreted for you to see any way that it can come in exam. Fair value adjustments. Let me share the solution and show you so that you can know now. Okay. Additional information 1, fair value adjustment, revaluation surplus. How do you know there is a revaluation surplus? The question will tell you categorically. 1, the question will tell you categorically that there's a revaluation, or it will give you the two assets. It will give the asset. It will give you the carry amount and the fair value. You will not compare. If it has increased, fair value surplus, it has increased. The PPE must be debited. Surplus, it has increased in value. The fair value has increased. The land, if you want to acquire somebody, sorry, okay, if you want to acquire somebody, let's say you want to acquire a land in 2016, the land was purchased in 2016 in Lekki, Lagos here for 500 million. But today value, it has increased to 800. They will give you the value of the two, the carry amount in the book and the fair value as today to get you valuation surplus. That is the second way. The third way, you compare it with the PPE. They only give you the fair value of the PPE. You will not compare it to what is in the book. You go to the non-current asset. You go and look the value of the PPE of the subsidiary. You not compare with the fair value. They only say the fair value of the PPE. They will give you the fair value. It's only 3 ways they use to test. The first one, the second one have been tested regularly. The third one have not been tested in ICAN exam, but it's tested in where ACC and it's part of the syllabus. They can test at any time. They will just give you the fair value of the PPE. When we get to PEP, you will see that kind of question. I will show you. Okay. Then accounting entry, debit. We debit PPE. If I'm debiting PPE, I'm increasing it. That means plus. My reserve will also be increased by 1.2 credits. Then the PIP, if it is revaluation deficit, opposite, if you have no one, you have no the other one, PPE will be credited and reserve will be debited. If I'm crediting my PPE, I'm reducing it. If I'm debiting my reserve, I'm reducing it. Depreciation. If there is a revaluation surplus, the depreciation, PPE will be credited. But because you are not charging depreciation correctly, it's supposed to be inclusive of that revaluation surplus. That means the profit you reported in the year is not correct. I will not debit adjusted return of the subsidiary, the one we revalue. If it is the parent, the same thing. You will see some question, parents will also revalue. I will show you when we get there. Now, PPE, debit, adjusted, if it is revaluation deficit, PPE, you have been overcharging yourself, debit, adjusted return of subsidiary, I will credit. And as per this question, look at it. Based on this question, PPE, debit 2 million, that is 2,000. Reserve, credit. Now, depreciation, 2,000, he has a useful life of 10 years, times 6/12, 100. What do? I credit. I will not credit my PPE. Adjusted return of subsidiary, debit 100. Let's see the post now. Let's see the post. I've opened the account down. I'm just posting. I'll just post. I will now write plus 2,000 revaluation surplus. That of the parent PPE, that of the subsidiary, plus revaluation surplus of 2,000 minus the depreciation. The second leg of the 2,000, you go to the reserve. The reserve, a credit, 2,000, revaluation surplus, 2,000. Then adjusted return for the depreciation will suffer 100. That is additional information 1 taken care of. I will just be picking them from additional information 1, 2, 3, 4. Immediately I've opened everything, I will just be posting additional information 1. I will read everything, post it, go within 20 or 25 minutes in exam, I'm done because I've opened all my account down already. Okay? Having said that, let's go to additional information 2. But I want to give you 2 minutes to react to the additional information 1. 2 minutes. Because we have so many to do today. 2 minutes to react to the additional information 1. And I think this approach is better than yesterday one. Let's do it by additional information the way we used to do it in class. Okay? Think somebody? Okay. Now, I will now move to additional information 2. Next, let's go to additional information 2. What does it say? Let me share that for you to see. Good. Additional information 2. Additional information. Bola transfer raw material at a cost of 4 million to Ambody, no problem. The way he bought it, he transferred it to him. Does not add anything. In June 2016, Ambody processed all this material, incurring additional direct cost of 1.4 million. That means the 4 million plus 1.4 million, making the total cost of the material is now 5.4 million. And sold them back to Bola in August 2016 for 9 million. That is wrong. He sold it at a 9 million. 5.4 now become 9 million. There's element of profit, but no problem. Is there any goods see at the reporting period? Is there any unsold goods? As at 30 September, Bola had 1.5 of these goods still in inventory. There were no other intergroup sales. That is what he said. Okay, no problem with this. What do I do? It's very clear. What do I do? It's very clear. Let's first of all realize that 9 million minus 9 million is total intergroup sales if I'm doing my POL. I will not bother the POL. Immediately statement of financial position balance, I'll just be noting my key figure that will go there. Intergroup sales. Total intergroup sales for the year is 9 million. And he made a profit from there because after the processing cost, everything is 5.4. He sold it at a 9 million. But unfortunately, there is inventory at reporting date. And if there was no inventory, what is my own duty? I'll just go to additional information 3. If they say all the goods have been sold, that means it has been realized. It's not within the group. The profit is not within the group. It has been realized. I'll just go waka pass, go to talk additional information. Only what I will notice is the intergroup sales. But here the question says he had unsold. Let's go to the solution for additional information 2 so that you can see. Additional information 2. Let's go to additional information 2. Unrealized profit on inventory. This is the formula when you see this kind of question. Profit over selling price times unsold. The profit he made, how do you know? Cost of raw material. Look at the cost of raw material is 4,000. The processing cost 1.4, making a total cost of 5.4. He should have sold it back at 5.4. If he sold it back at 5.4, what is my own duty? Waka pass. I told you yesterday, and I showed you with Dragon. For me to know there is unrealized profit, 2 things must occur. There must be element of profit. 1, margin, markup, the formula 1. This is the formula 1 we are talking. The next one, the second, there must be unsold. If there is element of profit, but there is no unsold, waka pass. If there is unsold, there is no element of profit, waka pass, go your own way. As even he sold it back to him at 5.4. No element of profit. But there is unsold. I waka pass. You have to eliminate unrealized profit on inventory. Now, that is the total cost. Selling price is 9,000. Unsold 1.5. Profit 9,000 minus 1.5 will give me 3.6. The unrealized profit on inventory. This is the formula. Profit. How much is the profit? 3.6 over selling price, which is the 9,000, times the unsold 1.5. It will give me 600. Debit the seller. Accounting entry. Accounting entry now. You have to debit the seller. Debit the seller. Say debit seller 600. Credit consolidated inventory 600. Who is the seller? Subsidiary. I will just go to adjusted return of subsidiary. Let's go there. You will now see adjusted return of the subsidiary. Adjusted return of the subsidiary. Adjusted. Unrealized profit on inventory. Oh, debit is account. I will now credit consolidated inventory. Look at the consolidated inventory. Credit minus 600. That is that on information 2. That is that on additional information 2. That is that on additional information 2. Please react to that in 2 minutes or 3 minutes. React to that if there is any question on this unrealized profit on inventory before in 2 minutes. In 2 minutes. In 2 minutes. If there's any question on it. Then we'll now go to additional information 3. If happen parent is the seller, debit the retained of the parents. Rest of us open the account down, everything. Okay, 1 more minute. Okay, let's go to the third additional information. Let me share the screen for the question. Additional information 3. Bola has recorded investment in Ambody at the cost of immediate cash payment, other equity investment. Yes, they say he has recorded it. That's what I'm saying. It has recorded it, 30,500 in equity. Because I don't see investment, I know that is where it's going to be. Other equity investments are carried at a fair value through profit or loss as at October 2012. The other equity investment has fallen in value by 200,000 during the year, that is September 2016. It has fallen in value by 200,000. It has fallen in value by 200,000. What do we mean by that? It has fallen in value by 200,000. In line with IFRS 9, what is the fair value at the beginning and at the end, as at the reporting date? He said it has dropped by 200. That means the financial assets must be credited, and I will not debit return of the parent for the volume value that the investment has impaired by 200,000. Volume value by 200,000. That is what I will do. So let us go to the adjustment, the solution. Let me share. Okay. Okay, additional information 3. The financial asset will be credited 13,500 and cost of investment. We are seeing on additional information 3. Financial asset 13,500. He said it's recorded it in equity investment. The financial asset will credit it. Cost of investment will be debited. But the cash he has recorded there, we remove it. We want to calculate goodwill. But it has fallen in value by 200. It has fallen in value by 200. Financial asset credited. It has fallen in value by 200. Financial assets credited to reduce the value. Financial assets is an asset. If I'm crediting asset, what am I doing? I'm removing from it. Because he said it has impaired. Say it has fallen in value. That, oh, the value of the instrument at the financial assets as at the beginning was so. But at the end of the day, it has fallen down by 200. I will debit the return of the parent, 200. Look at it. Let's go up to see the posting. Return of the parent. Return of the parent. Impairment on financial assets, 200. Then I will go to the financial asset to go and reduce the value, minus 200. Financial asset minus 200. That means other investments he has is 2.3. The financial assets that remain is 2.3. Is 2.3. 16,000 he reported initially. That 16,000 include cash payment per share of 1.5, which we have converted to bond, we now minus it. Why? Because it has been recorded, and we need to calculate goodwill. We need to calculate goodwill. For me to calculate goodwill, this 13,500 must be part of this thing. It has been recorded here. I will remove it and put it to goodwill calculation, credit investment, and debit cost of investment for the goodwill calculation. That is that on additional information 3. Now, let's go to the additional information 4. Let's go to additional information 4. Additional information 4 is the policy to value non-controlling interest as level at date of decision for the purpose of all items in above statement. Additional information 5. All items in above statement of profit or loss are deemed to accrue fully over the years unless otherwise indicated. That means they can be prorated because of the retained earning at date of acquisition. We have gotten everything. We are through with all the additional information. But the retained earning at the date of acquisition must know. How do I determine the retained earning? We have read all the questions. They've not given me the retained earning. They just say require consolidated profit or loss, consolidated statement of change in equity for the year. You are a professional, nobody will ask you consolidated statement of change in equity and consolidated statement of financial position for Bola as at 30th. Prof. Adesua, can you hear me? Prof. Adesua.
Yes, I can hear you.
Thank you.
I can hear you clearly.
Shamaka, it should be from your own end, though. Okay? They can't ask you that. That's why I neglect it. Nobody at this level will ask you changing in equity. That is for every level. Then see, even in ever, they don't used to ask. See, I say we should consolidate statement of financial position. Okay. And I say, okay, no problem. Let me go and share the solution for the retail. Look at the screen. Determination of retained earnings of subsidiary at DOC. Okay. Now, determination of retained earnings of subsidiary at DOC. And sharing is first. What? Prof. Prof. Hello, Prof. Adesua.
Yes, I can hear you.
Can you see my screen?
Yes, I can. Yes.
Okay,
sir.
let us, because it's saying your screen sharing is paused. Okay, no problem. Determination of retained and subsidiary at date of consolidation is at date of acquisition. Mistake on the typing. Date of acquisition. Retained at date of acquisition, let it be Y. Loss for the year. He made a profit, he made a loss of 4 6. Date of acquisition to date of consolidation is 6 months. Retained as SOLP is 12,000. The formula now, we say the formula retained at date of acquisition plus loss for the year equals to retained as a statement of financial position. That means retained is Y, Loss for the year is 4/6, but I'm not entitled to the 4/6 because I only acquire for 6 months. I'm only entitled to have for 5th, which is 6/12. We retain any statement of financial position is 12. I will now say y plus minus 23 equals to 12,000. Plus times minus will give us minus. Y minus 23 equals to 12,000. Y will now equals to 12,000 plus 23 when I collect the lifetime. Y equals to 14,3. That means the retained earning at the date of acquisition equals to what? 14,3. That is why you have this net assets at date of acquisition. See our net asset at date of acquisition. Net assets, retained earning, 14,3. You're not going to be given. Use the formula. You are not going to be given. Use the formula. You are not going to be given. You use the formula. Okay? Can we retake? Let me retake that part again. Let me retake that retained earning again. Now, they are not going to give me retained at date of acquisition. Don't, please, this is date of acquisition, not consolidation. The retained at date of acquisition is Y. Loss for the year, it made a loss. If you go to the profit or loss, the subsidiary made a loss of 4/6. Date of acquisition to date of consolidation is 6 months. The retained is statement of financial position of the subsidiary, not adjusted though. Retained as statement of financial position is 12,000. The formula to use retained and date of acquisition plus loss for the year equals to retained. Y plus minus 4/6. It cannot be entitled to the loss of 4/6. We prorate it. That is why all items in financial statement are deemed to accrue evilly to give us room for proration. Times 6/12 equals to 12,000. Retained statement of financial position. Y retained at date of acquisition plus 2,003 minus 2,003 equals to 12,000. We all know plus times minus will give us minus. Then Y now equals to Y minus 23 equals to, by the time I collect lifetime, Y will now equals to 14,000. That is the end of the question. Technically, you will now balance your book by going to the, okay, net asset at date of acquisition. We've known that, 2-3. We have gotten our cost of investment. Add NCI, we have gotten evaluation of NCI, our purchase consideration. Net asset at date of acquisition, 2-3. Is more than the purchase consideration. Gain on purchase bargain is to be credited to retain any of the parents. If you go to the return of the parents, let's go to the return of the parents, the 3-4, which is normally reversed as negative goodwill because the net asset is greater than the man bargained very well. The 3-4 must be credited to retain any. Gain on purchase bargain, 3-4. 3-4. 3-4. Then I will now go. I'll bring the adjusted retain down. My share here, adjusted retain 11.3. Post DOC minus DOA will give me loss of 3,000. How do we share the loss? Based on the group structure. It's okay. Hence, the date of acquisition is 3.6. Share of loss is 0.25 times 3,000. Loss of 750 will give me 2.8. Then the parent share of loss 3,000 0.75 will give me this that I will now put everything inside my statement of financial position. So there is no goodwill to be dashed. Now, the current asset minus your unutilized profits, I'll put that. Somebody say you can't see the question. We are sharing solution yet. I will take you to the question. NCI 2850, retain any of the parents, the share capital of the parent to be reported, equities of the parent, 5,000. When you add everything, it will give you 86,900 as the total asset. Can't see what we are explaining. Oh.
Can't see your screen clearly. Please, I would like to advise every student, you can always zoom in or zoom out of your screen. So if you can't see the solution or question clearly, kindly zoom into your screen so you see the letters boldly or figures. Thank you, sir.
Can you see my screen? Because it's
I
in
can
my
see
screen.
your screen.
What is in my screen now?
Determination.
Oh, you can't see my screen too. You can't see my screen too. It's not determination. I've changed it to Bola. It's saying.
No, that's not what we can see, sir.
It said, what do I do? About 4 people is talking now. They can't see my screen. I cannot see. They cannot see because it's saying. Okay. Now, can you see my screen now?
What I can see is consolidated statement of financial position.
Good. I think the students have want to confirm too. Can they see? Huh? Something is wrong. No, so yes, where are we now? You can see my screen. I said, let us determine the retained earning. That is what I said. Determination of the retained earning. Determination of the retained earning at the date of acquisition. I believe you can see my screen now. I believe you can see my screen. Determination of the retained earning subsidiary date of acquisition or consolidation. Let the retained earning at date of acquisition be Y. Loss for the year, 4/6. Date of acquisition to date of consolidation, 6 months. Retained earning as at SOFP, 12,000. Formula, use the formula retained at date of acquisition plus loss for the year equals to retained earning statement of financial position. Now, Y plus 4/6, because loss for the year is 4/6, retained at date of acquisition, let it be Y. We have said that. I'm not entitled to hold the whole loss of 4/6. The parent does not entitle because he only acquired for 6 months. Times 6/12 will give me Y plus 23. Y plus minus 23 will equal to 12,000. Plus times minus will give us minus. Y minus 23 will give us what? 12,000. And when we collect the right time, everything will give us 14,300. Then immediately we have our retained at date of acquisition. I will just put it into the net asset. We get net asset date of acquisition, which is net asset date of acquisition. Let me take you there. We're almost there. Oh, retained earning 14,300. Then adjusted retained, after adjusting everything, 11.3, depreciation minus unrealized profit minus 11.3 minus 43 will give me a post of loss 3,000 minus 3,000 because it was date of consolidation minus date of acquisition. Date of acquisition will come first, date of consolidation will come last. So if DOC is lesser than DOA, it will give you share of loss. How do they share the loss? Based on the group structure. Based on the group structure. Now, if you look at the group structure, share of loss 3,000 times 1.75 will give you this. Then NCI value at DOC. We want to know the NCI. NCI date of acquisition 36. Share of loss 0.25 times 3,750 will give you 2,850. With this, I can now put all the figures together. I'm done. Can I go to my statement of financial position? You all know it is the equity of the parents only. The share capital of the parents, 30,000. The retained earning of the parents, 29,750. After I have summed it up here, after I have summed the retained earning up, as SOLP, 28,500. Contingent consideration, he made a gain of 300. The impairment of 200. Gain of purchase bargaining, 34. Then the loss is giving 29,750. I will report the 29,750 in the statement of financial position, 29,750. Statement of financial position, and the NCI to 2,850. Then the current liability I will add, they will give me the total assets of this. Hope this is clear. Immediately after this one is balanced, there is nothing concerning me with the POL. I'll just be adding figure. Let me go to the POL. Revenue of the parents, 110 plus 60,000, that of the subsidiary, times 6/12, minus all the total intergroup sales, which is 9 million. After processing cost of material, is selling back 9. With this one, I will now go to the cost of sales. Cost of sales is the only calculation we do here. I will go to the cost of sales, which is down. I've done the cost of sales. Look at the cost of sales. Parent cost of sales in the question, 88,000. Subsidiary cost of sales, 7,000 times 6/12. You give me 33,600. Total intergroup sales, 9,000. Depreciation to be added to the cost of sales. Unrealized profit on inventory is 600, not 100. Mistake from typing, 600, making a total of, if you look at the total, you will get it 11,300. 11,300, which I will remove from here to get my gross profit. I will remove from here to get my gross profits. To get my gross profit. My gross profit of 20,700. Then distribution cost of the parent, 3,000. Don't add it to 200, 2,000. No, it's in bracket 2,000 times 6/12 times 3,000. It will give me 4,000. But if you say 3,000 plus 2,000, 5,000 times 6/12, that will give you 2,500. That is wrong. Is the parent, is the subsidiary. You're only entitled to 6 months of the subsidiary. 2,000 times 6/12 was the distribution cost of the parent. We give us 4,000. Administrative expenses, 525 plus 24 times 6/12. It will give me 645,450. Then finance cost. Oh, 0 is that of the subsidiary times 6/12. 0 plus 250 will give us. So to give us profit before tax of 10,000. Then the tax 35, but the subsidiary has a tax credit, tax relief of 1,000. That's why you are seeing the minus. Tax relief of 1,000. 1,000 times 6/12, 500. 35 minus 500 will give us for 3,000. Profit for the period, 7,000. I will now get profit attributed to NCI and the parent. Always know that the parent is the balancing figure. I will go and calculate the profit of the subsidiary. I will report the profit of the subsidiary Let's go to the damn question. You will see what I'm saying. Profit of the subsidiary. Oh, loss of the subsidiary, 4/6 times 6/12, 2/3. It does not share depreciation very well. It must remove from his account 100. Unrealized profit on inventory, 600. Everything must make up 3,000. In the post, if you go to the post, we also give you 3,000. If you go to the post, you also give you 3,000. Post 3,000. Also give 3,000. How do they share the 3,000? Oh, I will now go, how do they share the 3,000? We now say 0.25 times 3,000 will give me 750. The total profit to share, 7,000. What is the balancing figure? 7,750. Don't go and say 7,000 minus 7,000. No, it's 7,750. How do you get that? How do you get that? It's very simple. You said X plus Y, the parent plus NCI, you will give us 7,000. But the parent, this NCI is minus 750. Minus 750 plus parent equals to 7,000. Collect the lifetime, it will give you 7,750. So, and if you minus 7,750, it will give you the profit for that. That is it. Please, we have able to, our time has gone. Okay, let's react to the question and give us your suggestions, question, and any other thing. Oh, yeah, let's ask question on area that is not clear. Yes, somebody was asking question there, unrecorded and non recorded. Ask your question. We only have 5 minutes to ask question. We are going to go to, we are going to order. We are going to other question. If somebody asks what is recorded or not recorded, when they say it is recorded, that means the accountant they have in the book has recorded their investment in statement of financial position. He has recorded it. The investment is not for 1 year. It will be in non-current asset. He has recorded it. They are preparing it on course. We have to use our IFRS 3 knowledge, business combination to prepare consolidated. They prepare separate account on course. That is why it will be recorded in investment. Because I want to use that part of that money for the calculate, the one he has recorded to calculate goodwill, I will go there and go and credit that investment and debit cost of investment. But if it has not been recorded, then it has not been going to investment, no need. I will just take it to cost of investment, in debit the cost of investment. Another part that need to be affected in the statement of financial position, I will credit other part too, or debit as the case may be, based on the cost of investment they gave us in the question. Please always take note of that. Please, when it is recorded or not, please ask question. Go to Shelley. Ask question. Ask question, please. Okay. If there is no question, I don't know. Maybe I should restart. I can't access my maybe network. It is network. I can't access my. I can't access my. I don't know whether people have been asking question. Can't access it. Please let me stop share. Okay. Okay, I can access my shares channel. Please, sir, the finance cost on the share estate for loan does not reflect in the consolidated POL. I noticed that in the yesterday question on Premier. It has been recorded. They posted it for us. And even it has not been Mrs. Jumoke or Miss Jumoke, please, it has been recorded. Go to the site, the share estate for loan has been recorded. And if it has not been recorded, all these things you are saying, we will do it. If it has been recorded, we only need the part of that will go to the goodwill. That's the all. Please explain profit attributed again. Thank you. I will explain now. Profit attributed. Oh, now you must share the profit. Let me share the solution again to see. No share. Now look at the ground. Profit attributed, this 7,000. This 7,000. This 7,000 profit for the period. We've consolidated them. We need to get profit attributed to both the parents and NCI. How do we know that? It is very clear. It is very clear. How do we know that? That we need to share the profit. Okay, I will now say, what is, go to the solution. I believe you can see my screen. Now, the loss of the subsidiary, you first of all bring the loss, 4/6, but I'm not entitled to the whole loss, times 6/12 to give me 2/3. What are those things that he did wrong or he did right during the year? He does not charge depreciation correctly on fair value adjustment, 100. I will remove it from his account, but he has loss already. It will add to the loss. Unrealized profit of 600, we add to that, making 3,000. How many is he collecting from the 3,000? He's collecting 25% of the 3,000. Look at it. 25% of the 3,000 will give us 750. 0.25 times 1,000 to give us 750. Parent balancing figure. The total profit is 7,000. Then how can you now, if you remove 7,000 from 750 to give you 60 something? No, it's balancing figure. How do you get it? If it is minus, just add it to the 7,000. How? S parent plus NCI will equal to 7,000. NCI is not what? Minus 750 plus minus 750 plus minus 750 plus parent equals to 7,000. By the time you collect the lifetime, it will give you 7,750. Let me see, another question has been asked. Sir, is it not circumcised that post figure will be the same as profit for the year? Yes, if it is properly done, but society will come that will not make it to be the same. We will still get there and I will explain why the reason that. The majority of the time, it will be the same. But when it's no simple group again, it is now sub complex and all these things, which we are still going to do for next week. Fellow subsidiary, we must do it next week. Then maybe I should take a sub immediately. But we are not expecting sub in this diet. Our target for this diet that we think ICANN will set. This is the reason why we are not expecting sub. It was tested last diet. We will concentrate more on disposal, group cash flow, and piecemeal acquisition. One of those three will take the center stage. Immediately as finish with the fellow subsidiary, it's either I take group cash flow or I take a piecemeal acquisition or disposal of subsidiary. One of the three first, because those three is important. We first of all do those three because one of them will take the center stage. As I have said, when it becomes more complex, introduction of accounting standard, application of accounting standard, it will not be the same again. But if it is simple group, you can always see. Now, any other question? You have 5 minutes. Let us rush the other item. Solution to item. Okay. Remain 2 minutes more to ask your question. Let's go to Ida. I understand there's leave COVID. Let us be just focused. By God's grace, God will help us to put an end to this COVID. We all know we are going to write exam this year, no doubt about that. But the problem is the time. And I can say, immediately after the COVID, they will give 1 month preparation. Then they say they cannot write the exam under this current exam in any part, but no problem. Let us be focused. Dedicate time to your studies. By God's grace, and stay safe. COVID will surely be an ending by God's grace. So, no issue. Now, let's go to question 2 on Ida. Let me share so that you can see. Ida, question 2. If you can deal with, he has so many, but let us see what we can do tonight and 9 o'clock. Please, a minute. Okay, sorry for the break in transmission. Now, what we said, I said on October 1, 2011, Ida, a public sector company, acquired a 60% interest in CITA, paying 9 naira per share in cash. He paid 9 naira per share in cash. Okay. Prior to the acquisition, Ida had been experiencing difficult with the supply of components that it is used in its manufacturing process. CITA is one of the Ida main supplier, and the acquisition was motivated by the need to secure supply. In order to finance an increase in the production capacity of CITA, Ida made a non-dated loan. He made a non-dated loan. He made a non-dated loan at the date of acquisition of 4 million to CITA. 4 million loan. You cannot give yourself loan. Why? Because you're a single entity. You can't borrow yourself money. You are a single entity. That 4 million must be eliminated. To CITA, that carry a natural and effective interest of 10% per annum. The interest as 31st March on the loan has been paid by CITA and accounted by both companies. No, you cannot even collect interest. You cannot borrow yourself, let alone interest. it has been accounted for, are eliminated. That means it has been recorded. It has been accounted for. That one has paid finance cost. The other one has received it, finance income. I must eliminate it. The loan. Okay. Now, he gives us the income statement. Let's look at the income statement. Remember, when he gives us income statement on 31st March 2012, give us income statement on 31st March, and he acquired when? He acquired on October to March, 6 months. This is 6 months account. No retain any at the date of acquisition. And he has split the account into two, said pre and post. This is the post, this is the pre. This is the account of the parent, either, but the system has been split into pre and post. Now, when NCCA said this question, they reported so many failures. Now, investment, including the loan to system, he has recorded, look at it, said investment, including the loan to system. That means investment of that he used, 9 naira he used to purchase a subsidiary, it is also included here. It is also included here. Investment. He has said investment, which is pluralized. That means investment is subsidiary plus the loan. Maybe he also has other investment. Everything is 16,000. Immediately give me the question in exam. My first thing I will do, after I've read it, I'll now open everything. Page 1, POA, consolidated profit or loss. I'll open it. Page 1. Page 2, consolidated statement of financial position. I'll put it. PPE 18,400 plus 95. I'll go to investment 16,000 plus 0. Goodwill. I will write goodwill. I will leave space, 3-line space. Go to current asset. Open current asset account. Down. Current asset 18,000 plus 72. Then total assets. I'll go to equities and liability. Ordinary share premium, retain NCI. I'll put NCI. I will leave a space. Go to current liability. Non current liability. I will write it. 7% loan notes. I will open everything. After I've done that, all the accounts that I need to balance it, I need group structure. 1. I need adjusted retain of subsidiary. You leave like 7 pages. You have paid for the book. Use your book. Open. Use it. You cannot finish the book. Thank God you are not in ever. You are in CR. You have gone there. Have you ever finished the book? It's impossible. So open everything. Okay, group structure. You can use like four lines. Then adjusted retain any of the subsidiary. Leave like 8 lines. Your book. Determination of net asset. Leave 8 lines. Goodwill. Write the formula out. The return of the parent. Leave like 8 lines. NCI value. Leave like 8 lines if you like. It's your book. Then other workings. Now, the additional information. Before we go to additional information, let us first of all look at the share capital. Look at the share capital first. The share capital. 2,000 at 1 naira each. 60%, they acquire 60% of this, but this is the value. I need to convert it. I need to convert it to the nominal, to in units. I need to convert it into units. I need to convert it. So let's of us again digest this one. On October 2011, Ida Public Service Company acquired 60% group structure, 60, 40, parent 60. 60% of the total shares of 2,000, because the nominal value is of 1 naira. Total number of shares is 2,000. He paid 9 naira per shares in cash. As it been recorded, yes, inside investment. I will remove it. Credit investment, because I want to calculate the credit investment. I will not debit cost of investment. Say period to the acquisition of investment. Sister is one of either made supplier or those one are sorry. The loan he give to him, it must be eliminated. Loan investment, credit, loan liability. One will record it as an asset, part of his investment. Another man will record this as a liability. Let's see that. Look at it. 10% loan, no provider. The parent nil is was what I give. Subsidiary will record it as a liability. Why the parent has recorded it as what? Investment as part of this 16,000. Then interest is paid on the loan. Let me share the solution so we can deal with that and move to additional information. Let me share the solution now. This is either. I've opened everything. Now, all the account has been opened. The cost of investment. Okay, look at it. Now, date of acquisition, the date of consolidation, 6 months. 6 months. TNS, total numbers of shares in subsidiary equals the values of shares divided by nominal value. 2,000 divided by 1 give us 2,000. It gives us 2,000. 2,000. Parent shares acquire 0.6 times 2,000 will give us 1,2. 0.6 times 2,000 will give us 1,2. 1,2 what he paid 9 naira per share. 1,2 times 9 will give us 10,800. Will give us 10,800. This is not question time. I've shared the solution in your WhatsApp group. It's in your WhatsApp group. Let me resend to the WhatsApp group again. I've shared the solution to the WhatsApp group. It's in the WhatsApp group. I've reshared the solution again to the WhatsApp group. I don't know you don't have, but let's take part of it. Tomorrow we must have the solution. I'll also send another solution, then the one with associates, because we need to increase the pace of how we go about this lesson, because by July they are going to end and we have a lot of things to cover. No problem. Okay. Now you can get the solution in the WhatsApp. Okay, 0.6 times 2,000 onto Patrick. Prof.
Yes, Prof.
Can you can confirm to me? You can see my screen. What is on my screen?
Yes. I can see retained earnings of parents.
Thank you. So parent shares acquire 0.6 times 2,000 because they acquire 60%. We give me 1,2. He paid 9 naira per shares. 1,2 times 9 naira will give me 10,800. If it has not been recorded, I will say cost of investment 10,008 for goodwill calculation. Cash credited 10,800 to reduce my cash. But if it has been recorded, like this question now, it has been recorded. This question says it has been recorded. Therefore, recorded. Investments, credit, 10,800, cost of investment, debit. He has removed the cash already. It has been recorded. But because I want to apply IFRS 3 business combination, I need to debit the cost of investment for goodwill calculation, 10,800. Now, if it has been recorded, as I go ahead and remove my cash, I'm doing double posting. The accountant has recorded This is the tone. I don't know, maybe you are just hearing this one in the FR, in the CR. It is also in FR. The problem is that sometimes we pass out of luck, but we will meet it in the later period, or we are just getting better understanding of it. The giving loan must be eliminated. Loan investment, credited. Loan liability, 4,000, credited. He has collected interest on the loan. Interest on the loan. How many percentage? 10% interest. 4,000 times 0.1 times 6/12, 200. One will record it, I will debit finance income because interest is what? Item of the POL, not item of statement of financial position. I will debit the finance income. To remove the 200, don't collect. You are a single entity. You cannot make profit from your what? So you cannot make interest. Your finance income must be debited. Finance cost, I will credit. I will post this thing. So what length I have done, I will post it immediately. This thing I've done, as I'm reading the question, I'm posting immediately. I will eliminate the loan. See my solution. Immediately I will be post, eliminate the loan to get mark. I will not wait to do everything. I will eliminate the loan minus 4,000 to give me link. Okay, I will go. Oh, loan investment minus 4,000. 10,800 remove. It has been what? Recorded. The interest, okay, finance cost of 200. I'll post immediately. Wow, don't collect 350 plus 0 minus 200. Is the post we are going to take? Oh, we are still coming there tomorrow. The pure head. 420 plus 200 minus 200. Finance cost. So no, don't collect the 200. I will eliminate because they are a single entity. Immediately as I'm reading and post. Then that is that on the first part before I go to additional information. Please use 2 minutes to ask question on this. Two minutes to ask question on this. Please take note of the double entry. To make it fast, you cannot be writing the double entry. You know what to do when there's a revaluation surplus or deficit. When there's unrealized profit on inventory. When there is one we have done, loan to be eliminated so that to make the job faster as we move on. In the absence of no question, let us go to the question. Let me share again. Oh, somebody has asked question. Yes, that the cost of investment has not been recorded. Then, debit cost of investment and credit cash to remove the cash has not been recorded. Please, you must understand this part. Some people will use 3 costs of investment. 1 will have been recorded, 2 will not be recorded. I will look for higher level question and send to you today for practice. It asks everything. I will look for it and send to your WhatsApp group today. Higher level question. So that you can see how they ask question on different way and how to get it right. and how to get it right. Please, my brother, it is very clear. If they say recorded, meaning accountant has posted, no need for us. But because we want to calculate goodwill, if we must remove that thing, that one that he has recorded in investment that concern our goodwill calculation, we must remove it. If not, it will not balance. It will troubleshoot by that figure. Double posting is an investment. We are using it for goodwill calculation again. That is what the law says. I'm not the one. IFRS 3 business combination. I'll put it out. Get that part. Okay. Okay. Let's go to additional information. Okay. Thank you, Mr. Gideon. You said you get it now. I'm happy that you have gotten it. Thank you, and I expect others. Please, in case you have any issue, private chat us and we will get it solved. Please. Okay. Now, let's go to the question. Let me share. Let's take some additional information before we call it a day. It remains. Okay. Now, let's go to additional information. Additional information 1. At the date of acquisition, the values of certain property and equipment were 1.2 million in excess. That means I will debit my PPE credit reserve 1.2 because it's evaluation surplus. Okay, in excess, the current amount. This will have no effect. This will have the effect of creating additional charge to cost of sales. Oh, the cost of sales, depreciation of 300. What do I do to the depreciation? Credit the PPE by 300. Depreciation they used to have charged because of evaluation surplus. Debit adjusted retain any of the subsidiary 300. So that has not adjusted the fair value. That is that on information 1. Information 2, I will show you the solution now because of time. The post-acquisition period. System says to item we are 30 million, on which he made a constant profit. There is unrealized profit on inventory and selling price, 5% of selling price. What is the total sales? 30 million. The total sales is 30 million. That means total intergroup sales 30 million. But is there any unsold? He made a constant profit of 5% on the selling price. On this good, 4 million. We are still in the inventory of item. Oh, no problem. 4 million. Who is the seller? Subsidiary. There is unsold of 4 million. It's 5% on the selling price. That is margin. Selling price, margin. I will now say 5 over 5%, 5 over 100 times the unsold. How much is the unsold? The unsold is what? 4 million. Then anything I get, I debit to any of the seller and I credit consolidated inventory. This place happen to be subsidiary is the seller. I do what? I debit his account and I credit consolidated inventory to remove that part of unrealized profit. Additional information 3, including in item current liability is 1 million owing to system. You cannot owe yourself, but it's in the current liability, including in the current liability of 1 million owing you owe. I will eliminate the owing. Stop. I will eliminate the owing. No problem. I will eliminate the owing 1 million, 1 million. Impairment review that consolidate goodwill. Let me go to the solution and share you all those things we have talked about. Now look at the solution, additional information. One, we'll be doing the additional information. One, additional information. One, PPE debited, reserve credited, depreciation credit, adjusted return on subsidiary to credit. Then additional information two. Additional information two. Margin 5%, total intergroup sales 30, unsold 4 million, unrealized profit on inventory 5/100 times 4 million, 200. Seller, sub, debit is account, adjusted return, consolidated inventory, credit 200. Then, trade payable and trade receivable reconciliation. One, they both agree to the owing. Like this question, say you are owing me 1,000, 1 million, which is 1,000. We have part of it by 30. You say, okay, you cannot owe each other because you are a single entity. This is only three situations that can happen in exam when it comes to trade payable and trade receivable reconciliations. Now, agree to the owing. They both agree. No dispute between both subsidiary and parents. The parent saying you are owing me, the subsidiary agree. Or subsidiary agree, okay, you are owing me, the parent agree. What do we do? Because we are consolidating the trade receivable, you cannot owe each other. Credit 1,000, trade payable 1,000, remove it. That is one. Two, when cash or inventory is transit, but the total inventory of cash is in transit. What can be in transit is either cash in transit or inventory in transit. Let's take it. Take example of that 1,000. Let's say he has transferred all the 1,000. It's in transit. He has not hit that person's account. Oh, this is a mistake. This is a mistake. It is bank/cash, not trade payable. It's the bank/cash. Trade receivable 1,000. Cash/bank will be debited 1,000. Please take note. I'll make the correction tomorrow and put it is cash/bank, not trade payable. The 1,000 is in transit, so he has not received. I will debit my cash or bank 1,000, not trade payable. Please take note. But when part is in transit, let's take example. 400, yeah, 400 is in transit. It's only owing 600. 400 is in transit. Trade receivable 1,000 naira credit. I will credit to eliminate. From credit trade receivable, what am I doing? I'm removing it. Then cash at bank, debit 400 to increase my bank because it is coming in, it's in transit. The remaining we are owing will now be what? 600. Trade payable, which I will not debit. This is only three that can come in exam. But tomorrow I'll still go back through this one again. But the one the question asks us, he said they both agree to the owing. I eliminate the first one. Now, the question also talk about impairment. If it is impairment, it depends on the valuation of SCR. If it is share proportionate, because the goodwill getting for share proportionate belongs to the parent, and goodwill credited return of the parent debited. Please, then if it is fair value, both of them will share the blame based on the group structure. Please, let's stop here and take your question because I still have class to attend to FR by now. Please, I will give you 4 minutes. I will still continue this tomorrow. By then you have the solution in your book. I will send it to your WhatsApp, and I will still send some more, and I will send assignment for you to practice higher level. I can even find it today and send. Okay. Oh yeah, please ask question. Please ask question in the next 4 minutes so that we can call it a day. Ask question. The next remain 3 minutes more. One minute more. Yes, in the absence of no question, I thank you all. Tomorrow we'll continue from there. Thank you very much and have a wonderful night.